Welcome to Monarch Private Capital's Tax Incentives Webinar. There's a lot of excitement today around opportunity zones and their investment opportunities. Billy Uge, Managing Director with Monarch Private Capital Advisors, is here today to answer many questions about the benefits of the new Opportunity Zone program, what to look for in an Opportunity Zones fund, how to evaluate fund managers, and why now is the time to seriously consider investing. Billy is particularly qualified because of his vast experience in managing alternative investment strategies and his Opportunity Zone activities. Before I turn this over to Billy, I'd like to remind you that this presentation is for informational purposes only, and it's not intended to provide you with investment advice. Now here's Billy.
Thank you, Jane. Good afternoon. Many thanks for giving us some of your time today. Before we discuss Opportunity Zones, please allow me to give you a little bit of background on Monarch so that you understand our strategy and perspective. Monarch's a 15-year-old nationally recognized tax-advantaged investment firm that's focused on affordable housing, historic rehabilitation, film production, and renewable energy projects. We've closed over 100 funds. This included some 500 projects over a 25-state area since 2005. We've created some 20,000 affordable housing units. Today, we have over $500 million of assets that are being managed by our team across the country. In addition, we've invested about $150 million in over 50 historic rehabilitation projects in 15 states. When the OZ program was announced, we realized that we had significant exposure across the country. And that exposure actually had come from actually being in Opportunity Zone areas for over 13 years. Today, you will see that we have numerous affordable housing, historic preservation, and solar projects in many of these economically challenged areas that have recently been designated as Opportunity Zones. If you look at the map on the right, you will see where these various projects are, and you will see that they're diversified by type and by location. Keep in mind, the legacy relationships that we have had with developers have allowed us to have a very strong pipeline of opportunities going forward. So let's talk about what Opportunity Zones actually are. They're low-income census tracts that are designated by the state and federal government to attract tax-advantaged investments. These are truthfully private-public partnerships that are designed to spur economic development and job creation by enticing investors to invest in real estate and businesses in these designated areas. There are over 8,700 of these Opportunity Zones in all 50 states and Puerto Rico. If you look at the map on the right, you will see the red designates where these various zones are. When you get some time, you might be interested in clicking on the link that's at the bottom and drilling down into the communities that you might be interested in. It is interesting to note that 75% of these Opportunity Zones are in metropolitan areas. As Jane mentioned, there's a great deal of excitement related to these programs today, and the reason is because this is probably one of the most innovative and attractive programs the government has ever sanctioned. And it's at the federal level and trickling down to the state level. These different provisions allow investors to defer their taxes, reduce their taxes, and eliminate their taxes at times. If you are an investor who is going to realize gains, you have the opportunity to take the gain, split it from the principal, and reallocate those gains to qualified investments. It's going to allow you to get your principal back, diversify your holdings, continue to compound money tax-free, and for those who are coming out of 1031 investments, not have all the capital locked up into a real estate transaction that will continue to roll if you want to keep it tax-free. As of about 8 weeks ago, Treasury came out with additional clarifications and guidance, and now we feel we have ample guidance to give us total comfort in making our real estate investments in 2019. So what are the benefits? Let's drill down into the deferrals, reductions, and the exclusions. On the deferral, if you make a qualified opportunity zone investment, it will allow you to defer the tax that you owe on the gain either for 5 years or 7 years. If you invest by 12/31 of this year and hold it for 7 years until the 2026 period, you will have met the 7-year test and your tax on your current gain will be reduced by 15%. If you invest in a qualified opportunity zone fund by 2021, which is 12/31/2021, you will be allowed to reduce the tax by 10%, being that you will have held it for 5 years by 2026. And if you hold the investment that you roll the money into inside of a qualified opportunity zone fund for 10 years, there will be no tax on the investment made in that asset that is in the qualified fund when you liquidate that asset after a 10-year holding period. Let's take a quick look at what it looks like from a number standpoint. I've tried to outline the difference between a traditional investment and a qualified opportunity zone investment with $1.5 million gain. Let's look at the traditional investment first. You have $1.5 million gain. You're going to have to pay 23.8%. It's going to create a tax of $357,000 that you're going to have to pay, which is going to give you only $1,143,000 to invest. If you take the money and put it in a qualified opportunity zone fund, you do not have to pay the tax immediately, and the tax is deferred until 2026, which actually means until the tax date in 2027. It's going to be reduced by 15%, which will be taken down to $303,450. But it will allow you to invest all $1.5 million today in a qualified opportunity zone fund. So, 1, you have the gain separated from the principal. 2, you can defer the tax to 2026, and it's reduced to $300,450. You're going to have the $1.5 million reinvested, and if you look at the difference between $1,143,000 and $1.5 million at 9%, after you've paid the taxes, it is a meaningful difference when you net out the numbers. It's a 46% difference. You're going to end up with $1,747,000 versus $1,190,000 if you go into a traditional investment. The numbers are pretty powerful. So how do you invest in opportunity zones? You need to identify a qualified opportunity zone fund manager. Make sure that they understand what it takes to manage the fund and be compliant with the rules and regs. You, as the investor, need to sell the asset, and you can separate the principal from the from the gain. The gain needs to be reinvested into the fund within 180 days. The fund manager needs to reinvest that money into a qualified opportunity zone property within another 180 days. And within 30 months, the project needs to be completed and needs to pass the substantially improved test, which means the property basis must be increased by the amount equal to the original cost of the property. And keep in mind, there are assets that you cannot invest in, like golf courses, country clubs, racetracks, gambling facilities, massage parlors, hot tub facilities. So be sensitive to who you choose as a manager. Also note that when you go to invest in one of these funds, there will probably be two types of funds that you will see. One being a single asset fund and the other being a multi-asset fund. In the multi-asset fund, you're going to invest with a manager who's going to have discretion over the assets. It will be a blind pool. You will not know what the assets are until the manager chooses those assets. You will not know what the diversification is of those assets by type, geography, and number until you see what the manager does with the money that you give them. And at times, there could be a limitation as to the types of assets the manager could go into if the manager's running a sizable pool of money, which would limit him from going into smaller assets in a meaningful way. If a manager is using a single asset fund, it would allow the investor to build their own diversified portfolio if they can opt in or out of any of the given investments if they desire. It allows them to be able to terminate the program when they see fit versus being committed to a program that's going to have to continue to invest a sum of money that's in a fund until all of the money is invested. It therefore allows an investor to have an easier structure to be able to manage their future capital gains with single asset allocations. Let's look at what typically shows up in these funds, and I'm going to focus on real estate. There's no reason these are laid out this way, except to point out that commercial properties, including office and land and retail, seem to get bundled together more often than not in many of the funds that we have seen. Agricultural properties are there as well, as people are running businesses around farmland. Workforce housing, student housing, various renewable energy initiatives, senior housing, and hospitality have been broken apart into single initiatives. And we have found that many of those fit what we have done more than those in the top group. The process is pretty simple regardless of which strategy you're going to pursue, whether it be a single asset fund, multi-asset fund, or any of the given disciplines that I noted on the previous page. All of the managers are going to go try to source as many opportunities as they see fit within the areas they want to focus on. They're going to have a team that will evaluate those choices, underwrite them, find a way to invest in them, and monitor them. Let me touch a little bit on what we're doing as a firm. We've elected not to do a multi-asset fund, and the reason is we think that the single asset vehicles allow us to be more strategic and have a much more flexible investment program. We want to have transparency into the assets and be able to share that transparency with our investors instead of asking them to commit to a blind pool. It allows them to do many of the things that I mentioned earlier. They can diversify the assets as they see fit, choose which disciplines they want to be in and out of, and come in and go out of them as they wish, as long as they're compliant to the provisions of the Qualified Opportunity Zone Fund and the stipulations of the hold periods of the 5-year, 7-year, and 10-year. The targeted investments fit right into what we have been doing as a firm for the last 15 years, as we have been backing developers in workforce housing, student housing, solar and renewable energy projects. Senior housing and hospitality have been part of these various disciplines as well. We now have internal and external developers that we work with that create many of those projects that are in our pipeline. We feel that the characteristics surrounding many of the various workforce housing projects, renewable energy projects, and other areas that we focused on to be very compelling. We think that the next 15 to 20 years will play favorably into the hands of those that are investing in these different areas that I have noted here. Our corporate structure is one that allows us to leverage what we've been doing for the last 13 years. If you look at the acquisitions box and see underneath it the deal sourcing, negotiation, and structure, due diligence, and closing, all of that has been done on a regular and successful basis over 13 plus years for us. And we have been able to leverage our exposures in historic, renewable, and affordable housing to benefit the pipeline of opportunities that we've seen in the O-zones. And please note at the bottom of the page, I have listed the service providers. And regardless of whether it's us or others, just make sure that there are very qualified service providers that are monitoring and auditing and documenting all of the various investment vehicles that you're using in this space. Quickly, let's look at a couple of deals in our pipeline. We've got a very robust pipeline. It's growing daily. What you see here is roughly $50 million of OZ equity needs to go into a number of market rate workforce housing projects that we have that range from Alabama through Indiana, up into the Midwest and into the Northeast. I want to take a moment just to kind of profile one project we're working on right now so that you can understand, what we're doing and how we're doing it. And this is a project we're doing in Indianapolis, Indiana. It's the Westmont project, which is a adaptive reuse multifamily project and is in one of the better areas near downtown Indianapolis. This project's a good example of how our strategy works. The project sponsored TWG Development, which is a real estate development company specializing in commercial, market rate, affordable, and senior housing developments, approached us because of our legacy relationship with them to secure some OZ equity for the project. In response to TWG being a strong proponent of workforce housing, having a reputation for being very successful, and having been successful right across the street from where this project is, we agreed to partner with them in providing the OZ equity. This project has 188 units in it. It breaks down to like 29 studios, 97 one-bedrooms, 62 two-bedrooms. The neighborhood is in an area with very strong demand, high occupancy rates, high income per renter. And we have realized that this program provides a very attractive yield and multiple on invested capital. So we committed to partner with TWG and will be funding this project by sometime the middle of next month. If you look at the next page, you'll see that the after-tax IRR of this project is projected to be 13.1% with a multiple on invested capital of 2.1 times. We are not trying to be aggressive. We are not trying to create returns that are real high. We're trying to be very conservative, and we're trying to have a very, very low level of risk related to all of our projects. So let me close here. We've been operating in these opportunity zones for over 13 years. We've been working with development teams like TWG in these economically challenged areas successfully. We've created a tremendous amount of deal flow that's very attractive. We're trying to be very conservative, and we feel that this is the best way to pursue the benefits of the opportunity zones that require us to be committed to them for a 10-year period to have a successful exit when we can take advantage of a tax-free sale. If you all would like to have any additional material, please feel free to reach out to us. We'll send you a copy of this deck, any term sheets, and additional information that you might request. Thank you very much.
And thank you, Billy. We really hope this was very valuable to you. Please do call Billy at 404-307-0075 or email him at bhuger, which is BHUGER, at monarchprivate.com. I know he'd like to hear from you. Thank you so much for tuning in today.